Before we dive in, it is critical to understand that I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and informational purposes only and does not constitute financial or legal advice. You should always consult with a qualified professional before making any decisions regarding your insurance coverage. Your financial situation is unique, and the content of this presentation is not a substitute for personalized professional guidance. You just got the email. You open it, your heart sinks into your stomach, and you say the 4 words every single driver in America dreads. My insurance went up? Again? You didn't get a speeding ticket. You haven't been in an accident since that fender bender in college. You're driving the same reliable, boring sedan you've had for years. So what gives? Why does that number on your bill seem to have a mind of its own, always climbing, never falling? You feel powerless. You feel like you're being taken advantage of. And I'm here to tell you, you are. You are being played in a game where you don't know the rules, you can't see the scoreboard, and the house is designed to always win. But today that game ends. Forget everything you think you know about car insurance. Forget the cute gecko, the funny commercials, the promises of being in good hands. We are going to pull back the curtain on the entire multi-hundred-billion-dollar industry. I'm going to show you the secret rulebook the insurance companies use to decide what you pay. It's a rulebook they pray you never, ever see. By the end of this video, you will not only understand with crystal clarity why your insurance bill is so obscenely high, but you will also be armed with a toolkit of specific actionable strategies, the kind of insider knowledge that can slash your premium by hundreds, or for some of you, even thousands of dollars a year. This isn't about finding a $10 off coupon. This is about fundamentally changing your relationship with your insurance company, putting you back in the driver's seat, and keeping your hard-earned money where it belongs, in your pocket. So buckle up, because the truth about your car insurance is a lot stranger, and a lot more unfair than you ever imagined. Let's start by demolishing the biggest lie you've ever been told about car insurance. The lie is this: your rate is based on how you drive. That sounds right, doesn't it? Sounds fair. Good drivers pay less, bad drivers pay more. It's a simple, comforting idea, and it is almost completely wrong. Your driving record? That's just a tiny piece of the puzzle. It's the appetizer. The main course, the stuff that really determines your rate, is a complex, cold, and calculating algorithm that knows more about you than you might think. Imagine your insurance company isn't looking at you as a driver. Instead, imagine they're creating a secret profile of you like a dating app, but instead of trying to find you a match, it's trying to predict how much of a financial risk you are. This profile has nothing to do with whether you use your turn signal and everything to do with data. Hundreds of data points. And the most shocking part? Some of the most important factors have absolutely zero to do with what happens behind the wheel of your car. Let's talk about the first secret ingredient in this toxic recipe: your credit score. Yes, that 3-digit number from Equifax, Experian, and TransUnion. In almost every state, it is not only legal but standard practice for insurance companies to use your credit history to calculate your premium. They call it a credit-based insurance score. They claim that their data shows a statistical correlation. People with lower credit scores tend to file more claims. Whether that's true or fair is a debate for another day. The reality on the ground is this: if you have poor or even just average credit, you are being charged significantly more for the exact same coverage as someone with excellent credit, even if you have a perfect driving record and they have a history of accidents. We're not talking about a few dollars here. A study by Consumer Reports found that a driver with a perfect record but poor credit could pay over $1,500 more per year than the same driver with excellent credit. Let that sink in. $1,500. That's more than the penalty for a drunk driving conviction in some states. Your FICO score is literally more important to your insurance rate than a DUI. The system is punishing you for having student loans, a medical bill you're struggling with, or a period of unemployment 5 years ago. It has nothing to do with your driving, and it's costing you a fortune. But it gets even more personal. The second secret factor is your zip code. You might think, okay, that makes some sense. More car thefts or accidents in a big city versus a quiet rural town. And you're partially right. But the way they use this data is surgical, and it can feel deeply unfair. They aren't just looking at your city. They're looking at your specific neighborhood. They are analyzing claim data block by block. You could live on one side of a major street and pay $200 more per year than someone living on the other side, simply because their zip code has a slightly lower frequency of claims for hail damage or vandalism. Think about two identical twin sisters. Same age, same job, same perfect driving record. They even drive identical 2022 Toyota Camrys. One lives in zip code 90210 in Beverly Hills. The other lives just 10 miles away in zip code 90003 in South Los Angeles. The sister in South LA will pay, on average, more than double. We're talking over $2,000 more per year for the exact same policy. Why? Because the algorithm has determined her neighborhood is a higher risk. It doesn't matter that she parks in a locked garage, that she's never had a claim in her life. The algorithm has judged her based on her neighbors, and she pays the price. It's a system of digital redlining, and it's happening every single day. Now, here's the one that's going to make you really angry. This is the one that feels like a betrayal. The third secret factor that is killing your insurance rate is your loyalty. You heard me right. The very thing that every company in the world begs for, your loyalty as a customer, is being actively used against you by your insurance provider. For years, you've been a good customer. You pay your bill on time every 6 months without fail. You haven't shopped around because you trust them. You figure they'll reward you for your business. Wrong. They have a name for this. It's called price optimization. It's a fancy term for a simple, brutal strategy. Find the customers who are least likely to shop around for a better price, and then squeeze them for every last penny. The algorithm identifies you as a loyal or passive customer. It sees you haven't checked competitors' rates in a few years. And so, at your next renewal, it quietly adds a little extra to your premium. A loyalty tax. Maybe it's just $20. You might not even notice. Then another $25 at the next renewal, and another $30 after that. It's a slow creeping increase that, over 5 or 10 years, can result in you paying hundreds and hundreds of dollars more than a brand new customer would pay for the exact same policy. They are banking on your inertia. They are punishing you for your trust. The longer you stay, the more you pay. It's one of the dirtiest little secrets in the entire financial industry. So let's recap what we've learned so far. Your car insurance rate, that number that causes you so much stress, is not a reflection of your skill as a driver. It's the output of a secret algorithm that judges you on your credit history, your neighbors, and your unwillingness to switch companies. You're being penalized for financial struggles, for where you can afford to live, and for your own loyalty. It's a system that feels rigged from the start. And you might be feeling pretty frustrated right about now, maybe even a little hopeless. But don't be, because understanding the game is the first step to winning it. And we are just getting started. What I've just shown you is the why. Now we're about to get into the how. How you fight back. How you take on the algorithm and win. How you stop overpaying and start saving starting today. The first move on the chessboard against this machine isn't about your car. It's not about your driving record, your age, or even where you live. Not yet. The first move is to understand the secret weapon they are using against you. It's a number, a score that you probably don't even know exists. It's called your credit-based insurance score. Now hold on. This is not your FICO score. It's not the number you see on Credit Karma. It's a completely different algorithm, a proprietary blend of your financial data that insurance companies use to predict one thing, and one thing only: how likely you are to file a claim. To them, your financial habits are a crystal ball. And in most states, all but a handful, it's perfectly legal for them to use this crystal ball to set your price. They've run the data on millions of people, and their models have told them that people with lower credit-based insurance scores tend to file more claims. It doesn't matter if it's true for you specifically. It only matters that it's true for the group, for the statistical model. You are not a person to this algorithm. You are a collection of data points, and your wallet is paying the price for the patterns it finds. So what exactly is in this secret score? It's a cocktail of your financial life. First, your payment history. Do you pay your bills on time? Every time? A late payment on a credit card from 2 years ago might seem like ancient history to you. But to the insurer's algorithm, it's a bright red flag that screams unreliable. Second is your credit utilization. This is a huge one. It's the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and a $9,000 balance, you're using 90% of your credit. To an insurer, that signals financial stress. And people under financial stress, their data shows, are more likely to file claims, maybe for small fender benders they might otherwise pay for out of pocket. They're trying to predict your future behavior based on your current financial pressure. Then there's the length of your credit history. The longer you've managed credit responsibly, the more data they have to show you're stable. Stability is the holy grail for insurers. A short credit history makes you an unknown quantity, a risk. This is why a 22-year-old with a perfect driving record can get quoted a rate that's double that of their 50-year-old parent. It's not just about driving experience. It's about financial experience. They also look at new credit. Have you applied for 5 new credit cards and a car loan in the last 6 months? To the algorithm, that looks like desperation. It suggests a sudden, unstable change in your financial life, and again, that equals risk. Finally, they look at your credit mix. Do you have a healthy mix of different types of credit, like a mortgage, a car loan, and a couple of credit cards? This shows you can handle different kinds of financial responsibility. Think about it this way. Meet 2 people, let's call them Mark and David. Both are 35, drive the exact same Honda Accord, live in the same neighborhood, and have spotless driving records. Not a single ticket or accident between them. But Mark has a long credit history, pays his bills on time, and keeps his credit card balances low. David, on the other hand, recently co-signed a student loan for his sibling, opened a new store credit card to get a discount on a TV, and let one of his cards get close to the limit. When they both go for an insurance quote, Mark's is $400 cheaper for the 6-month policy. David sees that number and thinks it's because of his zip code, or because rates are just going up everywhere. He's wrong. He's losing hundreds of dollars because of a financial picture he doesn't even know his insurer is painting. So how do you fight back? You start by seeing what they see. You need to pull your report, not from some random website that promises a free score and then tries to sell you a subscription. You need to go to the one official federally mandated source, annualcreditreport.com. Let me repeat that because it is critically important. Annualcreditreport.com. This is the site created by the 3 major credit bureaus, Equifax, Experian, and TransUnion, as required by federal law, to give you free access to your credit reports. You are entitled to 1 free report from each of them every single year. Your first mission, the first step in taking back control, is to go to that website and pull all 3 of your reports. Don't just pull one, pull all 3. Why? Because they don't always have the same information. An error on your Experian report might not be on your TransUnion report, but you have no idea which bureau your potential insurance company is going to pull from. You need to see the complete picture. Once you have those reports in your hands, you become a detective. You are going to perform a forensic audit of your own financial life. You are looking for errors, and you will be shocked at how common they are. A 2021 study by Consumer Reports found that more than a third of volunteers had at least 1 error on their credit report. 1/3. This is your money on the line because of someone else's typo. What kind of errors are you looking for? First, look for accounts that aren't yours. A credit card you never opened, a loan you never took out. This could be a sign of identity theft, or it could be a simple mix-up with someone who has a similar name. To the algorithm, it doesn't matter. It just sees a debt you're not paying and it punishes you for it. Second, look for incorrect late payments. Do you see a 30-day late mark on a credit card that you know you paid on time? It happens. A clerical error, a glitch in the system, and suddenly your perfect payment history is tarnished, and your insurance quote skyrockets. Third, check the balances and credit limits. Is a card you paid off still showing a balance? Is a closed account still listed as open? Is the credit limit on one of your cards listed as $500 when it's actually $5,000? That one mistake could dramatically skew your credit utilization ratio, making it look like you're maxed out when you're not. Every single one of these errors is a weight, dragging your insurance score down and pulling money out of your pocket every single month. Finding them is step 1. Step 2 is fixing them. Under the Fair Credit Reporting Act, you have the legal right to dispute any information on your credit report that you believe is inaccurate. Each of the credit bureaus has a straightforward online dispute process. You can upload proof, like a bank statement showing you made a payment on time, and they are legally required to investigate your claim, usually within 30 days. This is not a passive game. This is the first, most powerful offensive move you can make. By getting your reports, identifying errors, and filing disputes, you are not just cleaning up your credit. You are actively debugging the very data the insurance algorithm uses to calculate your rate. You are forcing the machine to see you as you actually are, not as who a series of typos and errors says you are. This single action can, and often does, save people hundreds of dollars a year before they even think about changing their deductible or shopping for quotes. You have to see the board clearly before you can make the winning move. Cleaning up your credit report is like clearing the fog. But what if your report is perfectly accurate, and your score is still not where you want it to be? What if there are no errors to fix? That's when we stop cleaning up the past and start building the future. We move from defense to offense. And in the next part, we're going to break down the single most powerful strategy for actively boosting your insurance score. A strategy that has nothing to do with your driving and everything to do with playing the algorithm's game better than it plays you. And that single most powerful strategy is mastering a number you might not even know exists: your credit-based insurance score. Now hold on. Before you click away thinking, what does my credit have to do with my driving? That is exactly what the insurance companies want you to think. They don't advertise this. They don't put it in big, bold letters on their website. But behind the scenes, in the cold, calculating heart of their pricing algorithm, your financial history is screaming louder than your driving record. In many states, it's actually a more powerful predictor of your premium than a speeding ticket or even a minor accident. Let that sink in. How you manage your money can have a bigger impact on your car insurance bill than how you manage your car. Why? Comes down to one word: correlation. Decades of data, across millions and millions of drivers, have shown insurance companies a stark, undeniable pattern. People with lower credit scores on average file more claims. And not just more claims, more expensive claims. It's not a judgment on your character. It's not saying you're a bad person or a bad driver. It's a cold, hard statistical bet. The algorithm sees a low score and flags you as a higher risk. It predicts that you're more likely to be in a situation that leads to a claim. Whether that's because financial stress is distracting, or because someone who struggles to make payments on time might also defer critical car maintenance, the reason doesn't matter to the insurer. Only the data does. They are essentially giving you a financial responsibility score and using it to guess how responsible you'll be with their money if you get into an accident. So how do we fight back? We don't fight the system. We learn to master it. And the first step is understanding that your credit-based insurance score is not your FICO score. It's a different beast, a proprietary score that each insurance company calculates. But, and this is the crucial part, it's built from the exact same raw material. The data on your credit report from Experian, TransUnion, and Equifax. Think of your credit report as the ingredients in a kitchen. FICO has its recipe to make a credit score. The insurance companies have their own secret recipe to make an insurance score. But if you control the quality of the ingredients, you control the outcome of any recipe. So let's break down the 5 critical ingredients you need to perfect. First and most important is payment history. This is the king. It accounts for roughly 40% of your insurance score. It's simple. Do you pay your bills on time? Every single time? A single 30-day late payment on a credit card or a car loan can be a dagger to your score. It's a massive red flag to the algorithm that says, this person has trouble meeting their obligations. It doesn't matter if you just forgot, or if the bill got lost in the mail. To the algorithm, a late payment is a late payment. It can stay on your report for 7 years, a constant anchor dragging your score down. Getting this right is non-negotiable. The second ingredient, and this is where most people get tripped up, is amounts owed, or what we call credit utilization. This makes up about 30% of your score. This isn't about how much debt you have in total. It's about how much of your available credit you're using. Imagine you have one credit card with a $10,000 limit. If you have a balance of $9,000, your utilization is 90%. To the insurance algorithm, this looks like you are financially stretched to the limit. You're living on the edge. It signals high risk. Now, imagine that same person with the same $10,000 limit has a balance of just $500. That's a 5% utilization. This signals financial stability and control. The person with a 90% utilization will pay a significantly higher insurance premium than the person with 5%, even if they have the exact same driving record and the exact same car. The golden rule is to keep your overall utilization below 30%. The pro-level score-boosting secret is to keep it under 10%. Third is length of credit history, which is about 15% of your score. The algorithm loves stability and predictability. A long history of well-managed accounts is like a long-term relationship built on trust. It shows you're not a flight risk. This is why the advice to close your oldest credit card is often terrible. That card, even if you don't use it, is an anchor of stability on your report. Its age is a valuable asset. Closing it can actually shorten your average account age and cause your score to drop. Fourth is your credit mix, making up about 10%. The algorithm likes to see that you can responsibly handle different types of debt. A healthy mix might include revolving credit, like credit cards, and installment loans like a mortgage or a car loan. It shows you're a versatile and trustworthy borrower. This is a smaller piece of the puzzle, but it still matters. Finally, we have new credit, also about 10%. Every time you apply for a new credit card, a new car loan, or a new mortgage, it generates a hard inquiry on your report. One or two here and there is fine. But applying for 5 different credit cards in a month? That's a huge red flag. It looks like desperation. It screams financial trouble. And your insurance score will take a hit. So that's the theory. But theory is useless without action. Here is your step-by-step battle plan to seize control of these 5 factors and force your insurance score up. Step 1. Reconnaissance. You cannot fix what you cannot see. Go to annualcreditreport.com. That is the only official government-mandated site for your free reports. Do not go to any other site that promises a free score. You want the full-fat report from all 3 bureaus: Experian, Equifax, and TransUnion. Download them and print them out. You are now the general, and these reports are your battlefield map. Step 2. Clear the minefield. Go through each report with a fine-tooth comb. Look for errors. A misspelled name, a wrong address, an account you never opened, a late payment on an account that was never late. Studies have shown that over a quarter of credit reports contain serious errors. Finding and fixing one of these is the fastest possible way to boost your score. If you find an error, dispute it immediately online through the credit bureau's website. They are legally obligated to investigate. This isn't just spring cleaning. This is defusing a bomb that's been silently sabotaging your finances. Step 3. Automate your defenses. Remember, payment history is the king. The easiest way to protect the king is to build a fortress. Go into every single one of your accounts, credit cards, student loans, car payments, everything, and set up automatic minimum payments. Not the full balance, just the minimum. This is your safety net. This guarantees you will never ever have a late payment again, even if you forget. You can and should still pay more manually, but the autopay safety net ensures the single biggest factor in your score is permanently protected. Step 4. The utilization hack. This is the game changer. Most people believe that as long as they pay their credit card bill in full by the due date, their utilization will be low. This is wrong. Most card issuers report your balance to the credit bureaus on your statement closing date, which is often weeks before your payment is due. So you could charge $2,000 during the month, get a statement for $2,000, and then pay it off in full by the due date. You think you're at zero utilization, but the credit bureau saw that $2,000 balance for a month. The hack is to find out your statement closing date for each card, and then make a payment a few days before that date. By paying your balance down to near zero before it's even reported, you can make it look like you barely use your cards at all, sending your utilization score through the roof. By mastering this internal score, you've just taken control of the biggest hidden factor in your insurance premium. You're no longer a passive victim of the algorithm. You're actively shaping the data it uses to judge you. But this is only half the battle. Because now that we've fixed the data inside your financial profile, we need to tackle the external factors. The things about your car, your home, and even your job that insurers are using to quietly raise your rates, sometimes for reasons that seem to defy all logic. And in the next part, we're going to expose the zip code lottery and reveal why 2 neighbors on the exact same street can pay wildly different premiums for the exact same car and coverage. Imagine a single, ordinary street. On one side lives Sarah. On the other, just a few yards away, lives Mark. They both drive a 2022 Honda Accord. They're the same age, have spotless driving records, and identical credit scores. Yet, Mark pays 40% more for his car insurance than Sarah does. How is this possible? It's because the invisible line that runs down the middle of their street is a zip code boundary. Sarah lives in 90210, and Mark lives in 90211. Welcome to the zip code lottery, the single most powerful and often most frustrating factor in determining your car insurance rate. Your insurance company doesn't just insure you, they insure your environment. They are betting on the statistical probability of you filing a claim, and your location is the biggest variable in that bet. They use a system called territorial rating, which slices and dices the country not just by state or city, but by zip code and sometimes even by census tract, a level so granular it can change from one block to the next. So what are they looking at? It's a cocktail of risk factors. They analyze the frequency of accidents in your specific area. Is your neighborhood full of busy intersections, blind corners, and narrow streets? Your rate goes up. They pull crime statistics. Is your zip code a hotspot for auto theft or vandalism? Your rate goes up. They even look at population density. More cars and more people packed into a small area statistically means more chances for those cars and people to run into each other. Rate goes up, but it gets even deeper and frankly a little weirder. Insurers analyze weather patterns. Do you live in a hail alley in Texas or a part of Florida prone to flooding? They know the exact probability of an act of God damaging your car, and they price it in. They also look at the cost of living and doing business in your area. The cost of car repairs can vary dramatically from one town to the next. The hourly rate for a good mechanic in a major metropolitan area is going to be much higher than in a rural town. The cost to store a damaged vehicle at a tow yard, the price of a specific bumper or headlight, it all gets baked into the premium for everyone in that territory. And here's one of the most surprising factors: litigation rates. Insurance companies know, down to the county level, how likely people are to hire a lawyer and sue after an accident. If you live in a sue-happy area where small fender benders regularly turn into massive personal injury lawsuits, everyone's liability coverage costs more to compensate for that risk. This is why it can feel so unfair. You could be the safest driver in the world, but if you live in a high-risk territory, you are subsidizing the bad luck and bad behavior of your neighbors. You're being judged not by the content of your character, but by the statistics of your location. The insurer isn't looking at you as an individual. They're looking at you as one data point in a pool of thousands in your geographic area. It's a cold, hard game of numbers. Now, this macro-level view of your neighborhood is just the first layer. The next layer is your micro-location, where your car sleeps at night. When you get a quote, they will always ask you, where is the vehicle primarily garaged? And your answer to this question can swing your premium by a surprising amount. Think about it from the insurer's perspective. A car parked in a locked, private garage is the gold standard of safety. It's protected from thieves. It's safe from being sideswiped by a passing car. It's shielded from hail, falling tree branches, and other weather-related damage. The risk of a claim is incredibly low. The next best option is a private driveway. It's off the street, which is good, but it's still exposed to the elements and potential theft. A step below that might be a covered carport. And at the bottom of the risk ladder? Street parking. A car parked on the street is a sitting duck. It's exposed to everything. Hit and runs from parallel parkers, drunk drivers, thieves, vandals, hailstorms, you name it. The statistical likelihood of a comprehensive or collision claim for a street-parked car is exponentially higher than for one tucked away in a garage. So, if you tell your insurer you park on the street, you will pay for that increased risk. If you have a garage but you use it for storage and park your expensive car in the driveway, you are literally leaving money on the table. But the where doesn't stop at your home address. It also includes where you drive. Your daily commute is a massive piece of the puzzle. Driving 5 miles a day through quiet suburban streets to a local office park is a completely different risk profile than commuting 45 miles each way, in rush hour traffic, into a dense downtown core. Insurers have data on every major road and highway. They know which routes have the most accidents, the most congestion, and the most risk. Your commute is a daily stress test of your driving ability, and they price your policy accordingly. This directly ties into your estimated annual mileage. Insurers typically have 3 or 4 tiers for this. The low mileage tier, often for pleasure use, might be for people who drive less than 7,500 miles a year. The commuter tier could be from 7,500 to 12,000 miles. And the high mileage tier is for anyone above that. The logic is simple. The less time you spend on the road, the less opportunity you have to get into an accident. Less exposure equals less risk, which equals a lower premium. So, how do you fight back against the zip code lottery and turn these location-based factors to your advantage? This is where you can take back control. First, the parking hack. If you have a garage, clean it out and use it for your car. It's not a storage unit. It's a money-saving device. Once your car is safely inside, call your insurance agent and tell them your garaging situation has changed. Make sure your policy accurately reflects that your car is parked in a secure, locked garage. This single phone call could net you a 5% to 15% discount instantly. Second, conduct a commute audit. Has your work situation changed recently? Millions of people have transitioned to remote or hybrid work. If you used to commute 20 miles a day, 5 days a week, but now you only go into the office once a week, your annual mileage has plummeted. But your insurer doesn't know that unless you tell them. They're still charging you the premium of a high-risk daily commuter. Sit down, calculate your new weekly mileage, multiply it by 52, and get an accurate annual estimate. Then call your provider and update your policy. This is one of the easiest and most significant ways to lower your bill. Don't pay for miles you aren't driving. And third, and this is the ultimate pro tip, use insurance quotes as a real estate tool. If you are planning on moving, whether you're renting an apartment or buying a house, don't just look at the rent or the mortgage payment. Before you sign any paperwork, get car insurance quotes for the specific addresses you're considering. You might find that apartment A costs $50 less per month in rent, but because it's in a different zip code, it will cost you $80 more per month for car insurance. The cheaper apartment is actually more expensive. The difference between two neighborhoods just a mile or two apart can be hundreds, sometimes even thousands of dollars a year. Let the insurance data help guide your decision. It's a hidden cost of living that most people never think to check until it's too late. Your location tells a story of risk, from the crime rate in your zip code to the asphalt right in front of your house. By understanding how insurers see your world, you can start to make smarter decisions that directly impact your wallet. But where you drive is only half the story. The other, equally important half is what you drive. And it goes so much deeper than just sports cars are expensive to insure. The specific make, model, and even trim level of your vehicle hides a treasure trove of data that insurers use to calculate your rate. And in the next part, we're going to uncover why two nearly identical family sedans can have drastically different insurance costs, and how the car you choose to buy could be your biggest money saver or your biggest financial mistake. It's a tale of two neighbors. Let's call them Mark and David. Both are in their mid-30s, married with clean driving records and similar credit scores. They live on the same street in the same zip code. One sunny Saturday, they both buy new cars. Mark drives home in a brand new Toyota Camry LE. David pulls into his driveway a few hours later in a gleaming new Honda Accord Sport. They're both practical, reliable four-door family sedans from respected brands. On paper, they are peas in a pod. But when their first insurance bills arrive, the story takes a sharp turn. Mark's premium for the Camry is reasonable, right where he expected it to be. David, however, opens his bill and his jaw hits the floor. His premium for the Accord is a staggering $40 higher every single month. That's nearly $500 a year, for a car in the exact same class. David is furious. He calls his agent, convinced there's been a mistake. But the agent confirms the number is correct. So what's going on here? How can two cars that look so similar to us be so dramatically different in the eyes of an insurance company? The answer lies in the hidden data, the secret life of your car that insurers know all about, but most of us never even think to check. The first, and arguably the biggest factor, is the cost of repair. To you, a bumper is a bumper, but to an insurer, a bumper is a complex equation of parts, labor, and technology. Imagine a minor parking lot fender bender. On an older base model car, you might need a new plastic bumper cover and a few hours of labor. A few $100 maybe. But on David's new Accord Sport, that same bumper houses ultrasonic parking sensors, blind spot monitoring radar, and cross-traffic alert systems. A tiny tap that barely scratches the paint can damage a sensor that costs $800 to replace. And it's not just the part. These systems have to be painstakingly recalibrated with specialized equipment, adding hundreds more in labor costs. A simple fender bender can easily escalate into a $4,000 claim. Insurance companies aren't guessing about this. They have access to mountains of data from organizations like the Insurance Institute for Highway Safety, or IIHS, which performs low-speed crash tests specifically to determine repair costs. They know down to the dollar that the LED matrix headlight on one model costs $2,000 to replace, while the standard halogen on another is only $200. They know that the side mirror on a luxury SUV, with its integrated camera and heating element, can cost more than the entire engine on an old economy car. So when you get a quote, the insurer has already calculated the probable cost of every single potential claim for that exact year, make, and model. You're not just insuring a car, you're insuring a specific, and sometimes shockingly expensive, collection of parts. The second secret factor is your car's popularity with criminals. Every year, the Highway Loss Data Institute releases a list of the most stolen vehicles in America. And if your car is on that list, or even shares parts with a car on that list, your rates will go up. It's pure risk assessment. Think about the recent explosion of thefts targeting certain Kia and Hyundai models due to a vulnerability that was spread on social media. Owners of these cars, through no fault of their own, saw their insurance premiums skyrocket, or in some cases found it impossible to get coverage at all. Insurers saw a tidal wave of claims coming and immediately adjusted their rates to cover the expected losses. It's not just whole car theft either. It's also parts. Catalytic converters are a prime example. If your car, like many hybrids or trucks, has a converter that's both rich in precious metals and easy to access, you become a bigger risk. Insurers track these trends meticulously. They know which wheels are most likely to be stolen, which airbags are targeted, and which navigation systems are being ripped out of dashboards. If you're driving a car that's a magnet for thieves, you're going to pay a premium for the privilege. You are, in effect, subsidizing the criminal element. Now, here's where it gets counterintuitive. The third factor is safety. You think a safer car always equals cheaper insurance, right? 5-star crash test ratings, lane keep assist, automatic emergency braking. These should be a discount goldmine. And they are, to a point. They absolutely reduce the insurer's risk on the liability side of your policy, because you're less likely to cause a major accident and injure someone else. But they can have the opposite effect on your collision and comprehensive coverage. This is the safety paradox. That windshield on your new car? It's not just a piece of glass anymore. Embedded in it is a sophisticated camera and sensor suite that runs your car's advanced driver assistance systems. A rock chip that used to be a $100 repair can now necessitate a full windshield replacement costing over $1,000, because the entire system has to be professionally recalibrated to factory specifications. If it's off by even a single millimeter, your automatic braking might not work correctly. So, while the technology makes you less likely to crash, it makes any crash, even a minor one, exponentially more expensive to fix. The insurer has to balance the lower likelihood of an accident against the much higher cost of repair if one does happen. Finally, there's the fourth factor: the car's personality and what it says about its driver. Insurers are masters of statistics, and they found a strong correlation between a car's performance and the risk-taking behavior of its owner. Let's go back to Mark's Camry LE and David's Accord Sport. The Sport trim isn't just a badge. It often comes with a more powerful engine, a sport-tuned suspension, larger wheels, and a more aggressive look. To an underwriter, that car signals a driver who is more likely to accelerate quickly, take corners faster, and generally drive in a more spirited manner. This isn't a personal judgment. It's a cold, hard statistical reality known as moral hazard. The data shows that, as a group, people who choose the V8 muscle car over the V6 family sedan get into more accidents. People who buy the turbocharged, all-wheel drive rally-inspired sedan have more high-cost claims than those who buy the base model commuter version of the very same car. The insurer isn't insuring you, David the responsible family man. They are insuring the statistical profile of the average Accord Sport owner. And that profile carries a higher risk. So what can you do? The most powerful move you can make happens before you ever sign the papers to buy a car. As you're narrowing down your choices, don't just test drive the cars, test drive their insurance rates. Call your agent or use an online quote tool and get a real quote for every single vehicle on your short list. Don't just ask for a quote on a Ford F-150. Ask for the specific quote on the XLT trim with the 3.5-liter engine versus the Lariat trim with the 5.0-liter engine. The difference might shock you. You might find that the car that's $2,000 cheaper to buy is actually $3,000 more expensive to insure over 5 years, making it the worst deal. Shopping for insurance while you shop for a car is the single best way to avoid the expensive surprise that David got. You are turning the insurance company's secret data into your own powerful negotiating tool. We've dissected the metal, the glass, and the engine to understand how the machine itself sets your price. But the vehicle is only one part of this complex puzzle. The other major component is you. And insurance companies know a lot more about your personal life than you might think. In fact, one of the most controversial and heavily weighted factors has almost nothing to do with your driving at all. It's a 3-digit number that dictates much of your financial life, and it could be quietly costing you a fortune on your insurance. In the next part, we'll uncover the shocking connection between your credit score and your car insurance, and why fixing one could save you thousands on the other. It's a question that feels deeply unfair, and on the surface makes absolutely no sense. What on earth does your ability to manage a credit card have to do with your ability to safely merge onto a highway? It feels like an invasion of privacy, a judgment on your character that has nothing to do with your driving. And that feeling is completely valid. But to the insurance industry, it's not about character, it's about statistics. It's about a cold, hard, data-driven calculation that has become one of the most powerful and most controversial factors in determining your premium. They call it a credit-based insurance score. This isn't the same FICO score you see when you apply for a mortgage or a car loan, but it's built from the exact same information found on your credit report. Insurance companies have spent decades and billions of dollars analyzing data, and they found a persistent, undeniable correlation. People with lower credit scores, on average, file more claims. They file more frequent claims and they file more expensive claims. Now let's be crystal clear about what this means. It does not mean that having a low credit score makes you a bad driver. It does not mean you're more likely to run a red light or cause a pileup. The insurance company doesn't think that. The correlation is more subtle. Their theory is that a credit score is a snapshot of how you manage financial risk and responsibility. Someone who consistently pays bills on time and manages debt effectively is, in their eyes, more likely to be responsible in other areas of their life, like maintaining their car's brakes or getting their oil changed regularly. They see a person who is less likely to be under severe financial stress, which they believe can lead to distracted driving, or even a higher likelihood of filing a fraudulent claim. Whether you agree with that logic or not is irrelevant to them. The data is the data, and they use it to place you in a risk pool. A person with excellent credit is seen as a low-risk bet. A person with poor credit is seen as a high-risk bet, and they will be charged a significantly higher premium to offset that perceived risk. How much higher? The numbers are staggering. A study by the Zebra found that a driver with very poor credit, a score below 580, pays on average 114% more for the exact same coverage than an identical driver with exceptional credit, a score of 800 or above. Let that sink in. We're not talking about a few extra dollars a month. We are talking about doubling your car insurance bill. For many people, that translates to over $1,000, even $2,000 extra per year, paid out for no reason other than their financial history. It's a penalty for having medical debt, a tax for going through a divorce, a surcharge for losing a job. It has nothing to do with your driving record, but it costs you just as much as a DUI in some cases. This practice is so controversial that several states have taken action. California, Hawaii, and Massachusetts have banned insurers from using credit scores to set rates. Michigan and Maryland have placed heavy restrictions on it. They argue that using credit history is discriminatory, that it disproportionately penalizes low-income individuals and minorities who may have less access to traditional credit, creating a vicious cycle where being poor makes it more expensive to do basic things like drive to work. So, if you live in one of the other 45 states, you are playing this game whether you like it or not. Your credit score is a silent passenger in your car, whispering to your insurance company and costing you money. But this is not a lost cause. In fact, this is one of the areas where you have the most direct control. Fixing your insurance rate by fixing your credit is not a quick fix, but it is one of the most powerful financial moves you can make. So, how do you do it? First, you need to know exactly what the insurance company sees. You are legally entitled to a free copy of your credit report from all three major bureaus, Equifax, Experian, and TransUnion, once a year. The official place to get this is annualcreditreport.com. Do not go to other sites that promise free scores but try to sign you up for a paid service. Go to the official government-mandated source. When you get your reports, go through them with a fine-tooth comb. You are looking for errors. A study by the Federal Trade Commission found that 1 in 5 consumers had an error on at least one of their credit reports. 1 in 5. That could be a late payment that wasn't actually late, an account that doesn't belong to you, a credit limit reported incorrectly. These aren't just typos, they are daggers to your score. If you find an error, dispute it immediately. Each credit bureau has a straightforward online process for filing a dispute. They are legally required to investigate and remove any unverifiable or inaccurate information, usually within 30 days. Correcting a single serious error can sometimes boost your score by 50 to 100 points almost overnight. That alone could be worth hundreds of dollars off your next insurance premium. Once you've cleaned up any errors, it's time to focus on the two biggest factors that make up your score: your payment history and your credit utilization. Payment history is simple but not easy. It accounts for about 35% of your score. You must make every single payment on time. Even one 30-day late payment can devastate your score and stay on your report for 7 years. The easiest way to prevent this is to set up automatic payments for at least the minimum amount due on all your accounts. You can always pay more later, but setting up autopay is a safety net that ensures you are never late by accident. The second huge factor, and the one most people don't fully understand, is credit utilization. This makes up about 30% of your score, And it's simply the ratio of how much you owe versus your total available credit. Imagine you have one credit card with a $10,000 limit, and you have a $3,000 balance on it. Your utilization is 30%. If you have a $5,000 balance, your utilization is 50%. The lower this number, the better. High utilization signals to lenders and insurers that you might be overextended and financially stressed. Your goal should be to keep your overall utilization below 30% and for a top-tier score below 10%. The obvious way to lower this is to pay down your balances. But here's a powerful strategy that doesn't require you to suddenly find a pile of cash. You can increase your available credit. You can call your credit card companies and ask for a credit limit increase. If you've been a good customer, they'll often grant one without a hard inquiry on your credit. If they raise that $10,000 limit to $15,000, your $3,000 balance suddenly goes from 30% utilization down to just 20%. Your debt didn't change, but your score goes up. You can also consider opening a new credit card, as that new credit limit will be added to your total available credit, lowering your overall utilization. Improving your credit is a marathon, not a sprint. But every single positive action, paying a bill on time, lowering a balance, correcting an error, sends a new signal. And here is the most important part. Your current insurance company isn't checking your credit score every month. They priced your policy based on a snapshot of you from 6 months or even years ago. They have no incentive to automatically lower your rate as your score improves. This is why you must be proactive. As you work on your credit and you see your score climb, that is your trigger. That is the moment to go back and shop for insurance. The quote you get with a 600 score versus a 700 score can be night and day. You are, in the eyes of the algorithm, a completely different and less risky person. By taking control of your credit report, you are rewriting the story the insurance companies read about you. You are taking their most powerful, hidden weapon and turning it into your own personal discount code. But your credit score is just one piece of the secret data puzzle they use against you. There are other, even more personal details about your life that insurers are analyzing to decide your fate. Things you would never imagine could affect your car insurance premium. And one of them has to do with your job, and even whether or not you own a home. That's right. Your occupation, whether you rent or own, your education level, even your marital status. These are all puzzle pieces that insurers use to build a profile of you. A profile that has less to do with how you drive, and more to do with predicting how you might drive. It's all about statistics and correlations, and it can feel deeply unfair. Let's start with your job. You might think, what does being an accountant have to do with my ability to merge onto a highway? To an insurer, it has everything to do with risk. They have decades of data showing that people in certain professions are statistically less likely to file claims. Who are these golden drivers? Think engineers, scientists, teachers, pilots, and yes, accountants. The theory is that these professions attract people who are methodical, detail-oriented, and risk-averse by nature. An engineer who designs a bridge to withstand a hurricane is probably going to be pretty meticulous about checking their blind spot. A pilot with a pre-flight checklist for a 747 is likely to be a disciplined, focused driver. On the other end of the spectrum are jobs that statistically correlate with more claims. This isn't a judgment on the people in these roles. It's about the nature of the work. Delivery drivers, traveling salespeople, real estate agents. They're on the road constantly, often in unfamiliar areas under time pressure. More miles equals more exposure to risk, period. But it goes deeper. Jobs that involve high stress or irregular hours like doctors, surgeons, or even construction workers can also see higher rates. The insurer's logic? A tired or stressed driver is a distracted driver. It's a cold, hard calculation based on massive data sets. So when you enter your occupation into that quote form, you're not just telling them what you do for a living. You're being instantly sorted into a risk pool with millions of other people who share your job title. Now let's talk about something that seems even more disconnected, owning a home. Why on earth would an insurance company care if you pay a mortgage or a rent check? Because to them, homeownership is one of the strongest indicators of stability. In their eyes, a person who has gone through the process of securing a mortgage, who is responsible for maintaining a property, and who is literally tied to a specific location is a better risk. They see homeowners as more financially responsible and less likely to miss a payment. They see them as more mature, more settled. A renter, in their statistical models, is more transient and therefore slightly more unpredictable. But the real magic of homeownership for insurance is the power of the bundle. This isn't just a cute marketing trick. When you bundle your home and auto insurance, You are signaling to that company that you are a long-term customer. You see, the single biggest expense for an insurance company after paying claims is acquiring new customers. They spend billions on advertising. When they get a customer to buy 2 policies instead of 1, the likelihood of that customer switching to a competitor for a $50 difference in their car insurance plummets. You're stickier. You're more profitable over the long term. To keep you locked in, they are more than happy to give you a significant discount, often between 10 and 25% on both policies. It's one of the single biggest discounts available, and it's entirely based on your status as a homeowner. The personal profiling doesn't stop there. What about your education level? Again, it feels completely irrelevant, but the data tells a different story. Decades of claims information show a powerful correlation. The higher your level of education, the lower your likelihood of filing a claim. A person with a master's degree or a PhD, on average, costs the insurance company less than a person with a high school diploma. Why? The theories vary. Perhaps it's because higher education often leads to jobs with more stable hours and higher incomes, which in turn lead to living in safer neighborhoods with lower rates of theft and vandalism. Maybe it's a simple correlation with being more risk-averse in general. The reason doesn't matter to the algorithm. The only thing that matters is the result. This is why many quote forms will ask for your highest level of education completed. Leaving it blank could mean leaving a discount on the table. And then there's the classic one, marital status. For as long as car insurance has existed, married people have paid less than single people. This is one of the most time-tested rating factors in the industry. The statistics are overwhelming. Married drivers, as a group, get into fewer accidents, commit fewer traffic violations, and have drastically lower rates of DUIs compared to their single counterparts. The rationale is purely psychological. Insurers believe that marriage fosters a greater sense of responsibility. Suddenly, you're not just driving for yourself. You might be driving with your spouse, your kids. Your decision-making process behind the wheel changes. You have more to lose. You might take that corner a little slower, you might not try to beat that yellow light. You become, in the eyes of the insurer, a more predictable, more cautious driver. So what's really happening here? All these factors, your job, your home, your education, your marital status, are being fed into a complex proprietary algorithm. They are combined with your credit history to create something called an insurance score. This is not your FICO score. It's a secret internal number that each company calculates differently to predict one thing. How likely are you to cost them money? This is the fundamental reason why your quote can be $1,000 at one company and $3,000 at another, even with the exact same car and driving record. Each company has its own secret sauce for their insurance score. Progressive might put a huge emphasis on your credit history, while State Farm might give more weight to homeownership and a bundled policy. Geico might have found a profitable niche by offering great rates to government employees or members of the military. This feels invasive, and in many ways it is. Your entire life is being distilled down into a single number that determines your premium. But understanding this system is the key to beating it. You can't change your marital status or get a PhD just to save on car insurance. But you can be strategic. When you get a quote, be very specific about your job title. Sales is a broad category. Inside sales associate, who works from home, is a much lower risk than traveling regional sales manager. Don't lie, but use the most accurate, lowest risk title that fits your role. Always check the box for your college degree. And if you're a homeowner, the very first question you should ask is about the bundling discount. The most important takeaway is this. You need to find the insurer whose secret algorithm loves your specific life profile. Your goal is to find the company whose data models have identified people just like you as safe, profitable customers. That's the company that will offer you the best rate. We've now pulled back the curtain on almost every factor that goes into your premium. The car, your driving history, your location, and the deepest, most personal details of your life. But there's one final, crucial piece of the puzzle. It's the part you have the most direct control over. Yet it's the most misunderstood. We're talking about the actual policy itself, the choices you make on the quote form, the coverages, the deductibles, and the dozens of hidden discounts you're probably leaving on the table. And understanding these is the final key to unlocking hundreds, even thousands, in savings. Let's start with the basics, the absolute bedrock of your policy: liability coverage. This isn't optional. It's the law. Liability is for the other guy. It's the money your insurance company pays out when you are at fault for an accident that injures someone else or damages their property. It's broken into 2 parts: bodily injury and property damage. You'll see it written as a series of 3 numbers: like 25/50/25. This means your policy would pay up to $25,000 for one person's injuries, a maximum of $50,000 for all injuries in a single accident, and $25,000 for property damage. Now, here is the single most dangerous financial trap you can fall into. Every state has a legal minimum amount of liability coverage you have to carry. And millions of people, thinking they're being smart and saving money, just select the state minimum. This is like protecting a castle with a picket fence. It is financial suicide. Think about it. $25,000 for property damage. What happens if you look away for a second and rear-end a brand new Mercedes, a Tesla, or even just a modern F-150? The repair bill for those vehicles can easily hit $40,000, $50,000, $60,000. The state minimum won't even cover half of it. And that remaining $35,000? That's on you. The other person's insurance company will come after you for it. They can garnish your wages. They can put a lien on your home. They can seize your assets. Your life can be financially ruined over one moment of inattention. All because you tried to save $8 a month on your policy. The insane part is that increasing your liability limits is one of the cheapest upgrades you can make. Going from a disastrous 25/50/25 to a much safer 100/300/100 might only cost you $10 to $15 more per month. It is the single best investment you can make for your financial security. Don't ever skimp on liability. Next up are the two coverages for your car: collision and comprehensive. They're often confused, but the difference is simple. Collision covers damage to your car from, well, a collision. Hitting another car, a pole, a guardrail, flipping your car over. If you're moving and you hit something, that's collision. Comprehensive, or comp, is for almost everything else. Think of it as acts of God and jerks. A tree branch falls on your car. A deer runs out in front of you. A hailstorm turns your hood into a golf ball. Your car gets stolen. Someone vandalizes it. That's all comprehensive. Now, unlike liability, these are often optional unless you have a loan or lease on your car, in which case the bank will require them. But if you own your car outright, you have a choice to make. And the decision comes down to a simple formula: the value of your car versus the cost of the coverage. If you're driving a 15-year-old Honda with 200,000 miles that's worth maybe $2,000, does it make sense to pay $600 a year for collision and comprehensive? Probably not. You'd be paying a third of the car's value every year just to insure it against damage. A good rule of thumb is this: if the annual cost of your collision and comprehensive coverage is more than 10% of your car's Kelley Blue Book value, it's time to seriously consider dropping it. Just be honest with yourself. If you wrecked that car tomorrow, could you afford to repair or replace it out of pocket? If the answer is no, you might want to keep the coverage. This brings us to the most powerful money-saving lever you can pull: your deductible. The deductible is simply the amount of money you agree to pay out of pocket for a collision or comprehensive claim before the insurance company pays a dime. It's your skin in the game. And here's the golden rule: the higher your deductible, the lower your premium. Insurance companies love when you take on more of the initial risk. Raising your deductible from, say, $250 to $500 can lower your premium by 15 to 30%. Going from $500 to $1,000 can save you up to 40% or even more. Let's do the math. Say raising your deductible from $500 to $1,000 saves you $30 a month. That's $360 a year. In the event of an accident, you'd have to pay an extra $500 out of pocket. But after less than a year and a half of safe driving, you've already saved that extra $500 in premium payments. From then on, it's pure profit in your pocket. The key is to choose the highest deductible you can comfortably afford. The question to ask yourself is, if I got in an accident today, could I write a check for this amount without it causing a major financial crisis? If you have $1,000 in an emergency fund, a $1,000 deductible is a fantastic, calculated risk. If you have $50 to your name, you need to stick with a lower deductible until you're more financially stable. Now let's talk about the hidden money, the stuff they don't always tell you about unless you ask: the discounts. Every insurance company has a long list of them, and you are probably eligible for more than you think. This is not the time to be shy. You need to go through the list with an agent or on the quote form and check every single box that applies to you. First, there are discounts for who you are and how you live. Are you married? That's a discount. Own a home? That's a big one because they see you as more stable. Are you a college student with a GPA over 3.0? That's a good student discount. Have you taken a defensive driving course? The certificate from an approved course can shave 5 to 10% off your bill for 3 years. Think about your job. Many companies offer affinity discounts for people in certain professions: teachers, engineers, scientists, nurses, firefighters, police officers, and members of the military. They also have partnerships with alumni associations, credit unions, and professional organizations like the AARP. You have to ask. Then there are discounts for your vehicle. Does it have anti-lock brakes? An anti-theft system like an alarm or a tracking device? Automatic seatbelts or airbags? Daytime running lights? Many of these are standard on modern cars, but they're still listed as separate discounts you need to make sure you're getting credit for. The biggest discounts, however, come from how you do business with the company. The number one, no-brainer discount is bundling, also called a multi-policy discount. If you have your car insurance with one company and your homeowner's or renter's insurance with another, you are throwing money away. Period. Bundling them with the same carrier can save you anywhere from 10 to 25% on both policies. It's often the biggest single discount available. Similarly, if you have more than one car in your household, putting them all on the same policy for a multi-car discount is almost always cheaper than insuring them separately. And here's an easy one: how you pay. If you're paying your premium monthly, you're likely paying extra installment fees and service charges. If you can afford to pay your entire 6-month or 1-year premium all at once, you'll almost always get a significant pay-in-full discount. Don't have that much cash on hand? The next best thing is signing up for automatic payments from your checking account, or EFT. That and agreeing to receive your documents electronically, going paperless, can each knock a few more percentage points off your rate. Finally, we have to talk about the new controversial kid on the block: telematics, or usage-based insurance. This is the program where the insurance company gives you a small device to plug into your car, or has you download an app on your phone. It then tracks your actual driving behavior: how many miles you drive, what time of day you drive, how often you brake hard, accelerate quickly, or speed. The promise is huge. If you're a safe, low-mileage driver, you can get a massive discount, sometimes up to 40%. The peril is also huge. You are giving up your privacy. The insurance company knows where you are and how you're driving at all times. And if your driving habits aren't what they consider ideal, maybe you work a night shift or you have a heavy foot, it can actually backfire and lead to a rate increase. My advice here is to be brutally honest with yourself. If you drive 5,000 miles a year, never speed, and are in bed by 10 p.m., telematics could be a goldmine. If you're a traveling salesman who drives aggressively, stay far, far away. So now you understand your risk profile, the market, and the policy itself. You've got all the puzzle pieces, but how do you put them together in the most effective way? How do you actually execute the perfect quote request to make these companies compete for your business? That's the art of shopping smart, and it involves a specific strategy most people get completely wrong. And that's exactly what we're breaking down next. Alright, let's talk about the game plan. Because shopping for insurance isn't just filling out a form, it's a strategic operation. And if you go in unprepared, you're going to pay a laziness tax. But if you follow this process, you flip the script. You make the multi-billion-dollar insurance giants fight over you. First, we need to do our reconnaissance. This is the single most skipped step, and it's the most critical. You cannot win this game without first assembling your arsenal of information. Trying to get quotes without this is like trying to build a house without a blueprint. You need everything organized and in front of you before you make a single click or a single call. Here's your checklist. First, the basics. The full name, date of birth, and driver's license number for every driver in your household. Easy enough. Next, the vehicle identification number, or VIN, for every car you want to insure. You can find this on your current insurance card, your vehicle registration, or on the driver's side dashboard right where it meets the windshield. Also, get an accurate estimate of the annual mileage for each car. Don't just guess 12,000 miles because it's the default. Is it a 5-mile commute to work or a 50-mile one? Be honest, because they can and sometimes do verify this. But now, for the most powerful weapon in your entire arsenal. The one document that changes everything. It's your current policy's declarations page. This is the cheat code. Your deck page, as it's called in the industry, is a 1 to 3 page summary of your existing coverage. It lists every single coverage, every limit, every deductible, and every discount you currently have. Why is this so important? Because it guarantees you are making an apples-to-apples comparison. When you go out for quotes, you're not just looking for a lower number. You're looking for a lower number for the exact same level of protection. Without your deck page in hand, You might get a quote that's $200 cheaper, only to find out later it's because the new company cut your liability limits in half and gave you a massive $5,000 deductible. That's not a better deal. That's a trap. Your declarations page is your shield against that. It's your baseline, your source of truth. You will hand this information to every single company and say, match this and then beat the price. With your arsenal assembled, it's time to choose your battlefield. There are 3 primary ways to get a quote, and the winning strategy involves using all of them in a specific order. The first way is going direct to the carrier. This is you, on your computer, going straight to the websites of companies like Geico, Progressive, or State Farm. Think of this as using a sniper rifle. It's precise and can be very effective, as you're dealing directly with the source. The downside? It's incredibly time-consuming. To get a true sense of the market, you'd have to fill out 5, 6, maybe 10 different multi-page applications, entering the same information over and over again. The second way is using online comparison sites. These are the marketplaces like the Zebra, Insurify, or Jerry. Think of this as a shotgun. You enter your information once, and it blasts it out, bringing back a handful of quotes from different carriers all at once. It's fast, and it gives you a great quick snapshot of the market. The downsides are significant, though. First, not all carriers participate. Major players might be missing. Second, and this is a big one, submitting your info can sometimes lead to an avalanche of sales calls and emails. A pro tip: set up a free Google Voice phone number and a separate email address just for this process. It keeps your personal lines clean. Finally, the price you see on a comparison site is often just an estimate, not a final bindable quote. The third way is to work with an independent insurance agent. This is your special ops team. An independent agent is a licensed professional who works for you, not for a single insurance company. They have contracts with multiple carriers, often smaller, regional companies you've never even heard of, and their job is to shop the market on your behalf. They know the industry, they know which companies are best for certain driver profiles, and they do all the legwork. The drawback? They don't represent every company. They can't get you a quote from a direct writer like Geico, for example. So which one do you choose? The sniper, the shotgun, or the spec ops team? The answer is, you use all 3 in a coordinated 3-wave assault. This is the strategy that separates the amateurs from the pros. Wave 1, the online onslaught. You start with the shotgun. Pick 1 or 2 of the big comparison websites. Use your burner email and Google Voice number. Meticulously enter your information, using your declarations page to ensure you are requesting the exact same coverages you have now. This will take you maybe 15 to 20 minutes. The goal here is not to buy anything. The goal is to get a baseline. In minutes, you'll have 3 to 5 initial quotes. This instantly tells you if your current premium is reasonable, or if you're being wildly overcharged. You now have a benchmark. Let's say the best quote you get here is from a company called Travelers, for $1,200 for 6 months. Great. That's your number to beat. Wave 2, the direct assault. Now you pick up the sniper rifle. You're going to manually go to the websites of 2 or 3 of the massive direct carriers that may not have appeared in your comparison search. This is almost always Geico, Progressive, and maybe State Farm or Allstate. You will again fill out their applications, mirroring your deck page coverages. This is where your first quote becomes leverage. You already know a competitor is willing to do it for $1,200. This prevents you from getting anchored to a high first offer. You're now operating from a position of power. Maybe Progressive comes back and beats it at $1,150. Excellent. This is your new number to beat. Wave 3, the expert intervention. This is the final and often most impactful step. Now you call in your special ops team. You're going to find a highly rated, local independent insurance agent. Don't just pick one from a billboard. Go on Google, search independent insurance agent near me, and look for one with dozens of recent positive reviews. You call them up and you are direct and honest. You say, "Hi, I'm shopping my auto insurance. I've already gotten a few quotes. My current coverages are X, Y, and Z," which you know from your deck page. "And my best quote so far is $1,150 for a 6-month policy with Progressive. I'm wondering if you can use the carriers you represent to beat that price." You see what you just did? You've turned the entire process on its head. You're not a clueless customer asking, "What ya got for me?" You are a well-informed director of a competition. You have provided a clear target for a professional to hit. You've saved them time, and you've given them a concrete goal. A good agent will relish this challenge. They will now go to their network of carriers, including ones you don't have access to, and work to beat that number. They might come back with a quote from a company like Auto Owners or Erie Insurance for $1,050. And just like that, through a systematic three-wave process, you found the absolute floor of the market for your specific profile. One final, critical warning about this whole process. A quote is not a guarantee. The price you are given online or even from an agent is always contingent on verification. Before they finalize the policy, the insurance company will pull your official motor vehicle report to check for tickets and accidents, and a CLUE report, which is like a credit report for insurance claims. If you were completely honest about your driving history, your quoted price will almost always be your final price. But if you forgot about that speeding ticket from 2 years ago, the price will go up before you have to pay. Be honest from the start. It saves everyone time and prevents nasty surprises. By following this battle plan, you've systematically forced the market to work for you. You've used technology, direct access, and professional expertise in perfect harmony. You've taken control. You now have the lowest possible rate for the exact coverage you need sitting right in front of you. But the game isn't over. There is one last move. A final, powerful negotiation tactic that can shave off another 5 to 10%. It's a conversation that happens after you have your best quote in hand, and it involves a few magic words that can unlock hidden, discretionary discounts that agents are authorized to give, but almost never offer up front. That final phone call is the last piece of the puzzle. So you've done the work. You've shopped around online, you've compared apples to apples with identical coverage levels, and you have a final rock-bottom quote from a competitor. This quote is your golden ticket. It's your leverage. Now, you're going to pick up the phone and call the insurance company you actually want to be with. This might be your current provider you've been with for years, or maybe it's the company that gave you the second best quote, but has a stellar reputation for customer service. The goal here isn't just to match the price. It's to beat it, by accessing a hidden layer of pricing that is never, ever shown online. When you get an agent on the line, be friendly, be calm, but be direct. The script goes something like this. Hi, I'm looking at my policy renewal. Or hi, I just completed an online quote. And then you drop the bomb. And I'm trying to make my final decision. Right now, I have a formal offer from competitor's name for the exact same coverage for the lower price. I've been with you for 7 years, or I've heard great things about your claims department. Give them a reason you want to choose them, and I would much rather give you my business, but a difference of $300 a year is just too much to ignore. My question is there anything at all you can do to get closer to that number or match it? Now you pause. Let them do the talking. The first thing they'll do is review your policy for any obvious standard discounts you might have missed. They'll ask if you've taken a defensive driving course, if your car has an alarm, if you're a member of an alumni association. You will have already done this work, so you can confidently say, yes, I've already made sure all of those standard discounts are applied. This is the first gate. You've just shown them you're not an amateur. When they come back and say, well, it looks like that's the best price we can offer. This is the moment of truth. This is where 99% of people say, okay, thanks, and hang up. But you are not going to do that. You are going to deploy the magic words. You'll say, calmly and politely, I understand that's the best price in the standard system, but I've heard that agents sometimes have access to discretionary or retention discounts that have to be applied manually. Given that I'm a long-term customer, or given that I'm bringing over a multi-car policy, would you be able to check if I qualify for any of those? The key words there are discretionary, retention, and manually applied. These are insider terms. It signals to the agent that you know there's another level to this game. You see, most large insurers give their agents a small margin, a goodwill fund, or a retention budget that they can use at their discretion to save a customer who is about to leave. It might be 5%, 10%, maybe even 15%. It's not advertised. It's a tool they use only when their back is against the wall, and you have just politely but firmly pushed them against that wall. If they still hesitate, you can try another phrase. I'd hate to leave over this. Before I make the final switch, could you do me a favor and just double-check with your supervisor? I want to make sure we've exhausted every possible option to keep my business with you. This is a brilliant move. It's non-confrontational, but it escalates the situation. No agent wants to go to their supervisor and say, I'm about to lose a long-term customer, without having tried everything. The supervisor's job is to keep business, and they will often authorize the agent to use that hidden discount to save the account. Now, let's say you're dealing with your current insurer. and the frontline agent is giving you nothing. It's time for the nuclear option. But it's a very polite, very effective nuclear option. You say, okay, I really appreciate you trying. Seems like switching is my only option then. Could you please transfer me to the department that handles policy cancellations? I'll need to set a date for my policy to end. The moment you say the word cancellation, you are flagged in their system. You are no longer talking to a sales agent. You are about to be transferred to a retention specialist. This person's entire job, their performance metrics, their bonus, it's all based on one thing: convincing you to stay. They have access to discounts and offers that the initial agent could only dream of. They are authorized to do whatever it takes within reason to keep you. When the retention specialist comes on the line, you repeat your script. You're happy, but you have a better offer. You'd love to stay, but the numbers don't make sense. And you watch as they suddenly discover a loyalty discount or a special promotional rate that, miraculously, brings your premium right down to match, or even beat, your competing offer. Of course, what if it doesn't work? What if, after all this, they can't match the price? Then you walk. You have to be prepared to take the better offer. Loyalty is a wonderful thing, but it's a two-way street. If another company is willing to offer you the exact same protection for your family and your assets for hundreds of dollars less, then being a smart consumer means taking that deal. You thank the agent for their time and you make the switch, secure in the knowledge that you truly did everything you could. So let's bring this all home. Over these last 10 parts, we've torn back the curtain on one of the most confusing and frustrating expenses we all face. We started by understanding that your insurance quote isn't just about your driving record. It's a complex profile of you. It's your credit score, your zip code, your age, even your marital status, all fed into an algorithm designed to predict risk. We learned that the car you choose to drive can be a secret weapon or a hidden liability, with safety ratings and repair costs dramatically swinging your rates. We moved from theory to action. We uncovered the treasure trove of discounts that most people leave on the table. From bundling your home and auto to professional affiliations to simply being a good student. We explored the controversial world of telematics, weighing the privacy trade-off against the potential for deep discounts by proving you're a safe driver with real-world data. We demystified the shopping process itself, learning the absolute best times of year to shop for new insurance and understanding the critical difference between captive agents, independent brokers, and buying direct online, so you could choose the path that's right for you. We armed you with a checklist to ensure you're always comparing identical coverages, so you never accidentally sacrifice crucial protection just to save a few bucks. And finally, today we put the ultimate power back in your hands with the final phone call. The negotiation strategy that turns you from a price taker into a price maker. The single most important takeaway from this entire series is this: the price you are first quoted for car insurance is almost never the price you have to pay. It is an opening offer in a negotiation you probably didn't even know you were a part of. But now you do. You are no longer just a driver. You are an informed consumer, an educated negotiator, and the CFO of your own household. You have the knowledge to save yourself hundreds, maybe even thousands of dollars a year, not by cutting corners or reducing coverage, but by simply understanding the system and making it work for you. That money can go towards a vacation, paying down debt, or investing in your future. It's your money, and now you know how to keep it. If this series has helped you, if it's demystified even one part of this process or given you the confidence to make that one phone call, then do me a favor. Don't just like the video. Share it. Send it to one person in your life, your parent, your friend, your coworker, who you know is tired of overpaying. Let's stop the cycle of passively accepting high rates. And down in the comments, I want to hear your success stories. Tell us the magic words that worked for you, or the biggest discount you were able to unlock. Let's build a community of smart consumers right here. And of course, if you want to take control of other parts of your financial life just like this, make sure you're subscribed. Because the same way we just broke down car insurance, we're about to tackle homeowners insurance next. Thank you for watching. Now go get your money.